Hey guys, what's going on? So you probably know by now, any self-respecting trader should, that a book came out yesterday about the 1929 crash. And I'm going to actually discuss something that is not in the book, that was completely left out, that is critical to your trading. Now, the timing of the book, and by the way, for those of you not familiar, Andrew Sorkin is the author of the book. He is a CNBC host and contributor for a number of years. And, normally you would associate CNBC with a channel that talks about stocks going high every day. That's what they do every day without exception. But it came as a little surprise to me that he wrote the book about the crash. Now, there's been a lot of books written about the 1929 crash, and a lot of them are just a historic summary. And this is a good book, but it leaves out some of the critical information that you would need as a trader to go on from here. I'm recording this on October 15th, so you can make the most sense of the timing of this book. By the way, he started the book, the idea of how he came up with the book evolved in the crash, the Bitcoin crash of 2017 in December. You probably saw him a lot on CNBC at that point, and that's the moment where Bitcoin reaches 20,000 high, and then you know what happens for something that we accurately predicted here at 13 Market Moves. While everybody was bullish, Bitcoin drops from 20,000 to 3,500 within 11 months, and that's actually was one of the first videos that we posted here at 13 Market Moves. So that's how he gets the idea of the book. He's been writing it for 8 years, but I don't think this date that he picked out for the release of the book, which was yesterday, October 14th, is not a coincidence. Some of the major things, have historic, almost a coincidence as far as the day-to-day stuff that's happening in the 1929 crash and 1987. In both instances, the dates of October 14th through 17th carry a big significance, and you could say that that's really when the crash sort of begins. And so what I really want to, before I dive into the context, and I've been talking a lot about the context. As a trader, you should be looking at the context each and every time before you enter the trade. So it is important to look at multiple time frames of the context as well. And sometimes the easiest thing to do is to look at multiple time frames of the chart preceding to some of these big historic collapses. But also what's highly valuable is to look into day-to-day market movements preceding to a big event. So when we're talking about something that's called a big a Black Monday, Black Tuesday, Black Thursday, Black Friday, all those terms are associated with a climax. Normally, it's the biggest move within the crash. Now, most of the traders, especially in the last 5 years, that only seen the bull market, they don't even have a clue how crash looks like. We had a little bit of a preview on October 10th, and if you've been following the channel on October 9th, I posted a podcast telling you that, hey, in the next 12 days, something huge is going to happen, and you better go on puts, big on puts now. So you can go and listen to that October 9th, stamped on our 13 Market Moves podcast. But the point is, we're going to dive deep into each and every day of October 9th, 1929 through October 30th, so you have a better idea of what was taking place. I'm going to try to highlight some of the similarities, some of the things. Before we do that, let me just summarize the longer time frame context. So, and the significance of it is such that if you look back, of course, the market's been rallying higher in the 1920s. They're known as the Roaring 20s. But if you specifically zoom in the 12 months before the crash, okay, the market's been going higher consistently every month with the exception of February 1929, which to me is a striking similarity because all we've had in the last 12 months, so dating back to the Trump election last year, 2024, basically the market takes off in October and goes up every month until we actually have what? It begins dropping in February when the sentiment reaches its peak, and that's when the market reverses. So February, March, April was the April 2025 low, from which the market just made one of the biggest historic comebacks we've ever seen in the history of the markets. And so those are pre-existing conditions today, and it was similarly a pretty good match to those context of conditions in 1929. So basically, it was an up month every month in 1929, with the exception of February, leading to a market high that was set actually in September. So it is important to acknowledge some of the tops, double tops. And so to me, like if you look at every crash historically, the real market crash begins when the top is in. And my argument that I made last week is the top is in. And that's why I'm using the October 9th data to go and show you what was happening historically October 9th for the 30th, because I believe the high was set in the market, in basically dating to October 9th. Now, if we look at some of the other sectors in the market, such as, for example, Bitcoin. Well, Bitcoin set its stop. Now Bitcoin is at a double top. Bitcoin set its stop in September of 2025, and it set just a double top on October 9th, 2025. So to me, like the Bitcoin analog is even a better match for what the overall market was doing in 1929, because it almost like even the day-to-day high in Bitcoin is matched to the day-to-day high of the 1929, which, by the way, was September 3rd. So without any further ado, guys, let's take a look exactly at the 21-day context, okay? So October 9th, 1929, Wednesday, market conditions are, there's not a whole lot of stuff that's happening. The markets are calm, but very narrow trading range. Okay, so as you know, for the last 6 months, even though the market has advanced, close to 50%, it's been trading in a very narrow trading range. A narrow trading range could last for some time, but never in history does a narrow trading range last for a duration of what we've seen in 2025, which is basically, 6 months now. So now there was a moment in September of 1929 known as the Babson break. Now, Babson break is named after Roger Babson, who was known sort of as like a perma bear, because he started predicting the market crash a couple of years prior to the actual crash, and a lot of people have been brushing it off. But on September 5th, he does a speech in which he famously nails the upcoming 1929 crash. And here's what he said specifically, okay? This is exactly the quote from his speech. I repeat what I said at this time last year and the year before. The market will crash, and it's going to cause a major decline. 60 to 80 points back then was like, it was a huge drop. It was like 30, 40%. So more people are borrowing and speculating today than ever in our history. Sooner or later, the crash is coming, and it may be terrific. So, some of the key components of any crash is borrowing is on the rise, okay, and there's more speculation in the market than ever before, which is basically the conditions that are clearly met today in 2025, Okay, so we're talking like if we combine the speculation, just to give you a reference point, the margin back in 1929 to buy stocks of any sort, you could literally put 10% down, and that would give you a margin of 10x. So you can put $10 down, and they would allow you to borrow $100 to buy stocks with. Now, most of the trading accounts right now, as you know, they come in program with like automatic Forex when you open your brokerage account. But I would argue that, the situation is way worse because there's a lot more market participants now that developed over the years in the crypto markets, and any crypto market leverage is easy 100x. So for those of you that trade crypto futures, you can go 100x. Some exchanges will allow you to go 125x, 150x, 200x. So to me, basically what Babson observed in the markets right before they crashed, and his observation was accurate in September of 1929. Basically, he was pointing to the same things that are happening in the market right now. So basically, the market was coming back. So the market had a reaction after it set all-time highs on September 3rd. It was coming back after Babson made his comments. The market went down. And so by early October, it was recovering. And so everybody thought, well, hey, things are back to normal. Things are good. So you may look at last week, October 9th, everybody thought, hey, there's no way in the world, okay, crypto coins can go to zero. There's no way in the world crypto coins altcoins could go 90% lower. That was the general thought. Now, I've been talking to you guys for months how the crypto market was going to drop rather than go higher, how Bitcoin was going to drop rather than go higher, and I was basically using the stagflation case, but there's also a lot of simulation here in 1929 that I believe if crypto markets were trading back then, the drop in the crypto market would definitely exceed the drop in the general market. Now, what most of you probably don't know, because I haven't mentioned it a lot, that in 1929 begins the era of the biggest stagflation case. So if you listen to my podcast over the last year or two, you know that our base case here at 13 Market Moves was stagflation, and my argument has been pretty simple that stagflation is not good for crypto markets because crypto markets do well under a aggressive easing policy and quantitative easing, but in the case of stagflation, Federal Reserve hands are tied as far as to doing any massive kind of stimulus or any massive kind of a rate cut, a cycle. It doesn't mean that they cannot make an occasional cut, just like they did recently, but it does not mean that this is a cycle where Fed is going to be cutting and cutting and cutting, because there is always the probability of inflation running high at the moment, which is exactly what's going to happen. Now, I'm not sure if the economic data is going to show that, but that's basically why the Fed is not aggressively cutting, because they are concerned indeed about the inflation. So October 10th, 1929, okay, the market is beginning to show some cracks. And the quiet rally attempt, there's been multiple rally attempts throughout September and early October of 1929 before the crash. But that day in the history is described as a false sense of security. And consensus among bankers was that the worst was over. And so oftentimes you hear me in many podcasts bring up the fact that no big money was ever made by following the consensus, especially when you look at the context and the market is up, 50% in 6 months, or the market is up like it was in 1929, okay? The bankers will tell you everything is fine, but the reality, the market mechanisms has already shifted. And the transition in the market from October 9th to October 10th, 2025 was a, clear sign. It was kind of, I would say, the equivalent of the Roger Babson effect or day that could be compared to, September 5th of 1929. So there's on October 10th, the smart money, however, was beginning to get nervous, okay? You had some big leading stocks like U.S. Steel and General Electric began to show distinct weakness. Now, when we're talking about U.S. Steel and General Electric, those were sort of your ultimate best companies of the 1920s era. So there would be an equivalent today of something like NVIDIA or in any big time AI stock. So as you know, in the last few days, if you look at the chart of NVIDIA, it's been breaking. So to me, like if you look in the history and you try to replace some of these big names in the early October, particularly the break in U.S. Steel and General Electric begins in like October 10th. Now, the ultimate climax of the crash, the Black Monday, doesn't happen until 19 days later, October 29th, 1929. But as you can see, there's like early signs to look out. And so most of the people, I think, especially the new traders, they are mistaking the term of market crash for something that just drops in a big way. But the way you really trade the market crash is by identifying those early signs, early weaknesses in various sectors, especially if they're happening in the big names, in the names that have been leading the rally. So there's clearly some similarities here. Now, October 11th, 1929 was a Friday, and selling intensifies. Now, you guys know that some of the biggest drops we've had recently, including the October 10th, 2025, it is a Friday. So watch out for these big Friday drops. If I'd say based on the probabilities, this Friday, September 17th, could be another colossal drop, and definitely Friday, the 24th and the 31st of this month. Now, depending on how quickly things escalate here, I mean, we could actually be looking at the bounce by October 31st, because there's not a single crash that happens without a bounce. So if you look at the two most famous crashes, which is the 29 and the 1987, I mean, the bounce ultimately happens. Now, they're short-lived, and there's some reversals after the market bounces after the big drop, but it's something to definitely pay attention to, because that could lead you to a huge round-trip trade. So October 11th, Friday, 1929, the selling is intensifying. There's a definite negative shift. The decline is more decisive, and the volume is picking up. So what I want to bring to your attention here is the rallies in 1929. Like any day that you go and study in September and early October before the crash, it is characterized as weak volume, okay? The market is stalling, right, on these. Yeah, sure, you're getting green candles, but the market is stalling. And that's exactly what's beginning to happen on October 11th. There's more and more players of the market that begin to realize that the failure of the market to rally on a strong volume, okay, is evolving into a pattern, okay? And then in the midst, when you put the puzzle together, you have days like the Roger Babson drop in September that's preceding these things. So the context keeps building up, going into something that begins to escalate rather sharply. Now, the next thing I'm going to say is actually going to be a little bit of a shocker to most of you. Believe it or not, the markets in the 20s, they were actually opened on Saturdays. So October 12th, 1929, it's a Saturday. Now, it was half-day trading, right? But if we look at the size of the swings that were beginning to take place, like the measurement from high to low or low to high in a single trading session, the markets were beginning to move in a wild way. In other words, something you heard me use and say the term move expansion. So no longer do you have a tight trading range where a market moves like 20, 40 points on S&P recently, which has been a major characteristic of the market over the last 6 months. But what you really have now is a situation where market daily move begins to expand, which exactly what we've seen, right? And thank God we not only did we see it, but a lot of traders made colossal amount of money on that move expansion day, where normally you'd go in and see 20, 40 point move, but instead we got over 200 points at one point on October 10th. So with that said, on October 12, 1929, half day of trading on Saturday, okay, things were moving by, almost, well, they weren't quite moving as in terms of percentages as we had on October 10th, 2025, but they were getting in that direction. The market participants were beginning to get nervous. The trading to the upside, the volume again was extra thin. And when the market opens October 14th, 1929, which was a Monday, you have an acceleration of the sell-off, which would be described in terms of 13 market moves as a move 3. Okay, so you are transitioning from a market top, which are moves like 6, 11, into a move 3 type formation. Okay, and at that point, when you look at the volume characteristics, well, heavy selling is the way they were describing the market action on October 14th, if you study history. Okay, so especially the blue chip stocks that had led the bull market. Okay, and so the blue chip stocks back then, again, would be the equivalent of, the big 7, the magnificent 7 stocks, right? So you have your NVIDIA and Meta, Microsoft, Meta, all of these stocks. So the blue chip stocks back then, the biggest companies, you can't go wrong buying them. They got big balance sheets. They're making money, right? So it was the fact that on October 14th that the big stocks are beginning to break. And also an interesting historic fact that it is that week, the October 14th, Monday, 1929, in the history of all the economists ever lived in the world, Irving Fisher is probably one of the most famous ones. And so Irving Fisher picks that week to deliver a speech. And in that speech, he states, stock prices have reached what looks like a permanently high plateau. And so Andrew Sorkin book was released yesterday on October 14th, 2025. And I don't think it's by a coincidence that it matches this particular day in history. I'm not saying that Andrew Sorkin all of a sudden decided to predict the 1929 crash. Again, the reference I've given you, he's been writing the book for 8 years. It was sparked and inspired by the crypto collapse in 2017, December going into 2018. But considering how many hours he invested in making this book, I don't think October 14th release is a coincidence at all. So again, arguably the most famous economist, it's the October 14th that he stated in his speech that basically, according to his views, that was the ultimate top, even though it's not top of the market, but that to him was the top from which the market was going to go substantially lower. So October 15th, 1929, Tuesday, the market continues to slide, okay? The market opens weak, and it keeps sliding downward all day. The characteristic of volume, again, which is notable, is heavy. So, I mean, if you're sitting in front of your charts right now, just go and pull up your charts, guys, because what you're going to see is clear volume characteristics that are matching the volume description preceding to the crash, the ultimate crash in 1929. So, again, you have daily confirmation that the sell-off volume far exceeds any sort of buying volume. Buying happens on fumes. Sell volume happens on heavy volume. So the mood in the market, October 15th, was darkening. Winston Churchill, back then the UK's chancellor, was in New York, and he was watching the market closely. He actually went to the New York Stock Exchange. And he, according to the press, he was concerned about the big portfolio that he had built. That's why he went down there. So that tells you that some big-time politicians, okay, were also beginning to get concerned. So if you see some big short positions all of a sudden coming out of the blue in crypto world and the market world, okay, the same thing was happening. It was not advertised, but there were signs. October 16th, 1929, Wednesday. Okay, that's when the massive selling begins. And so it's no coincidence I'm recording this today on October 15th, 2025, because I believe the historic analog is very precise in what happened in 1929 and what is happening now. As you know, I'm also combining two other historic analogs in understanding of the crash that we're about to witness here, and that is the historic analog of 1973, 1974, and 2007, 2008, which I am basing on utilizing the gold chart. Okay, that is screaming again every day. Gold is going high. That screams that it's 1973, but yet somehow the market has not dropped 50% yet like it did in that historic time frame. And then the oil chart screams that it's 2007, 2008. So, but combining these three time frames, okay, I'm recording this ahead of tomorrow, October 16th, to give you guys enough of a fair warning, okay, that it's not too late to take some massive action here. So what we've got is basically October 16th, 1929, massive selling wave begins. So that could begin today, that could begin tomorrow on October 16th. But a huge wave of liquidations is hitting the market. Dow falls sharply. Late day rally is they're attempting to put together a late day rally, but it fails. The psychology of the market participants was that they finally saw that this was the point of no return. New York Times headlines next day would read, "Stocks driven down as wave of selling engulfs the market." That's the headline of New York Times on October 16th. October 17th, Thursday, markets condition, full-blown fear sets in. So you see how we went from September tight trading range, with the exception of a couple of down days, and the Roger Babson drop-off that basically was erased, but then the market comes back to early October, still trades in thin volume, but then with each day the selling begins to intensify, and it basically matches the day-to-day of what could be happening at any given moment in the current market condition. So October 17th, 1929, the selling panic continues. No respite. Stocks across the board fall dramatically. The financial system was seizing up. Brokers were demanding more margin, and the telegraph wires were clogged with sell orders from across the country. October 18th, 1929, Friday, market condition, quiet before the storm, price action. The market was quiet, but down sharply. The narrow range of the down day indicated exhaustion. So it looked like maybe the drop was slowing. But guess what? The weekend newspapers would be brutal. Headlines screamed of the week's collapse. Investors, brokers, and bankers faced a long, anxious 2 days. And even on Saturday, the half day, the market dropped. So in a short session, the market tried to stabilize, but ended with a steep loss. Like imagine, right? For those of you that only trade stock market, I mean, if the market was open Saturday, and whatever you normally do on a Saturday, right? I mean, you're sitting there and the fucking market is collapsing on a Saturday, right? That's what was happening on October 19th, 1929. Now, as you know, October 19th, this week is going to fall on a Sunday. And I would say the market is going to definitely make a big gap down this Sunday going into Monday, October the 20th. Historically, October 19th for 20th is known as the biggest day of one-day crash. That's got nothing to do with the 1929, but you know, some of the psychological aspects and some of the metrics as far as the context were similar. And I'm talking about October 19th, 1987 crash for a moment here. So market conditions, October 19th, 1929, Saturday. Remember, the market was crashing, which led to an actual panic when the market opened on Monday, October 21st. So the price action, you had a massive collapse on Monday, but you did have a late rally. So as you can see, even though, again, we're talking one of the biggest crashes of all times, that within those massive moments of panic, there were bounces, and they were basically like October 21st, that was still a great opportunity to short the market before the big collapse. Now, October 22nd, 1929, the market cools off a little bit. Nothing is happening. And it's not bouncing in any wild way, but it's not dropping in any wild way. So it's sort of a day of a pause, okay? But the psychology of the market that day, that at that point everybody sort of knew that they were staring in the eye of the hurricane, and the worst was about to happen, that this day of calamity was not the end of the storm, but rather the beginning of much bigger storm, evolving from Category 3 to Cat 5 to possibly even Cat 6. So October 23rd, 1929 is described in history as the point of no return. Price action, the market rolled over and plunged, decisively breaking the lows set on the 21st. So any day, right? So how would you put that in perspective to what's happening now? So October 10th, sharp sell-off, strong volume, crypto market, altcoins collapse, oil making almost touching a low that was set back in April of 2025. So oil market is falling apart, crypto market is falling apart, some indexes and some of the key stocks that have been pushing the markets, they're dropping, okay? And then now for the last couple of days, like October 13th, October 14th, the market is trying to stage a comeback, okay? And based on what I'm reading here, okay, it's going to fail. There's like almost 100% probability that the market is going to drop at some point today on October 15th, and the market is going to drop tomorrow on October 16th, 17th, and the big move is like the huge fucking gigantic move is going to be Sunday, October 19th through October 20th. So October 24th, okay, now check this out, the importance here is, like, once upon a while you have a crash, I'll be like, okay, it's a Black Tuesday, Black Monday, Black Friday, whatever. But if you look at the time frame here, like literally within 5 trading sessions, you're getting a Black Thursday and a Black Monday and a Black Tuesday. I mean, you're getting multiple black days, you know? And black days is not good in the markets, for those that are new here. So October 24th, 1929, officially described as Black Thursday, and that's the day that is characterized as full-blown panic. Price action, the market opened in a free fall, which is, again, it's a move 3 formation, a record 12.9 million shares changed hands, which at the time was the record. And so that characterizes, again, that heavy volume is on down days. You get almost non-existent volumes on days like October 21st when the market is attempting to bounce, but it's not really doing anything. So to me, that's sort of like what we've had recently, October 13th, 14th. And so that ultimately resolves in a Black Thursday. So the price action that we've had in the last couple of days ultimately leads to Black Thursday. And I'm not saying the Black Thursday is tomorrow, but I'm saying we could get a rather substantial move to the downside tomorrow on October 16th, 2025, which is going to resolve in a potentially Black Friday, Black Monday, Black Tuesday next week. But what was happening on October 24th, besides the record heavy sell volume, a consortium of bankers, they pulled money to support the market. Richard Whitney, who was the vice president of the exchange, New York Stock Exchange, famously walked into the floor and placed a high bid for U.S. steel, sparking a dramatic late-day rally. So imagine the market is collapsing on Black Thursday, and you have an intervention by the vice president of the exchange who walks in and makes it public. He's the highest bidder for what, let's say, would be an equivalent of NVIDIA. And that sparks a late-day rally, okay? But even actions like this, okay, couldn't stop the market from moving lower on the next day, which was October 25th, known as the day of hope and betrayal. So he gave them the hope the day before and created a small rally, but the entire rally was unwinded. And then the next day, at this point, it's no longer the vice president of the exchange that's in the limelight. It's the president of the United States, who was Hoover at the time, that is trying to make a speech and say, hey, the fundamental business in the country is great. Everything is good. Like something that you would hear Trump say, right? Everybody knows. I mean, United States is going to hell, but he'll tell you there, oh, we're winning. We're fucking, this trade war is great for us. He'll call a victory that everybody knows is a great fucking failure in every aspect. So Hoover, back then in 1929, which we're not going to get into tariffs, guys, but like we're talking about everyday trading and how it went. But, this is where Trump got his tariff idea from Hoover, which basically sent the country into the greatest stagflation case of all times. But for the sake of October 25th, 1929, so Hoover is trying to save the market. So on October 24th, you have the vice president of New York Stock Exchange trying to save the market. On October 25th, you got the president trying to save the market. Guess what? None of it fucking works. Okay? So Hoover's statement was intended to calm the markets, but was seen as hollow, which is probably this time around, if Trump is going to try to come back and save the market, it's going to backfire. Nobody's going to listen to this garbage anymore. So October 26, 1929, that's another Saturday, half day. Guess what happens? Another fucking Saturday, big swing. I'm talking about like half day Saturday on October 26 was like the equivalent. I mean, the size of the move was bigger than we just had on October 10th, 2025, from highs to lows. October 28th, Monday, Black Monday. So at that point, the market condition on Black Monday is characterized as organized, relentless collapse. Nobody was buying. At that point, they tried to rescue the market for a couple of days. Black Monday, nobody was buying. 13% drop in one straight leg lower for the entire day. So 13%, some people argue that Winston Churchill that day walked out of the New York Stock Exchange and calling it the biggest disaster or the catastrophe, or, you know, he used the words of that magnitude. General Electric, which would be an equivalent of, again, NVIDIA today, Radio Corporation of America, you know, I mean, those stocks were down 10, 20%. But there were stocks that were down as much as 60, 70% on that day. So we're talking about the best of the best stocks were dropping 10, 20% that day. Which my argument would be, I mean, if we're going to get a 13% one day drop in the market in the next 5 days, all of the AI stocks, they're going to be down double that what the market is going to drop. So we could see a day where NVIDIA is going to drop 20, 30% in the single trading session. October 29th, guys, Tuesday, goes down in history as Black Tuesday and known as the day of total capitulation. So that was apparently described as the worst day in history. Record sell volume, 16.4 million shares, which back then was the record. So basically you have another 12% drop after a 13% drop, but on the record sell volume. So in two trading sessions, the markets are down 25%. Now, they're calling October 29th Black Tuesday as arguably the worst trading day in history. But for someone like myself who is a short seller and makes money on betting against stupid markets when they're overhyped the way they are right now, there was one guy that actually made an equivalent of 1.5 billion that day. And you guys know, you should know, if you're a self-respecting trader, you should know who that is. And that was, of course, Jesse Livermore. Reminiscences of the stock operator. Okay, so he went down that day as the Great Bear, made a ton of money. So October 29th, 1929 is when he was closing his positions. And the equivalent of best AI stocks to that of October 1929 made a much bigger drop than the prior day. For example, U.S. Steel dropped from 262 to 180, which is like a 25% drop. And the day before it dropped, 15%. So you have like a 40% drop in arguably top 10 stocks in 1920s. AT&T, which even now known as like, it's a utility place, it's a safe stock, even that shit dropped 30% on October 29th. So October 30th, however, is known as the biggest dead cat bounce and goes down in history as the biggest suckers rally. which after that rally, the market drops another 90%, but not within such a short time frame. Okay, then you got the crash of 1930, 31, 32, 37. All of those were under conditions of stagflation. So if you've been following the channel, you guys understand stagflation by now. You should, and you understand how severe and dire current market conditions really are. So to summarize everything, even though the market was dropping overall, there were some strong bounces, and actually, believe it or not, there were 3 days within that time frame that we were going through where the market actually closed positive in the green. So for those of you that are trying to brush off the last couple of days saying, well, but the market bounced, it's in the green, the worst is over, I mean, you should probably go and study the history that I just explained in greater detail in the effort to help yourself understand that what seems to be the end of the crash that most of the people will remember forever, especially those in the crypto world. I mean, I wish more guys listened to 13 Market Moves channel, because it's not easy to have a contrarian view when the whole world's screaming, hey, buy crypto, fucking Bitcoin to $1 million, Ethereum to 60,000, and, that shit gets demolished. I mean, Bitcoin dropped 23,000 points on October 10th, but it's nothing compared to what some of the altcoins dropped, right? And, the general consensus is, oh, well, wait, altcoins is about to have the biggest rally of all times. Well, exactly the opposite happens. And who fucking told you about it? I fucking did, okay? I don't know many people that did it on such consistent basis while the market kept going higher and people just kept being bullish on all-time highs, thinking that shit's just going to continue going higher. The point is this: people think that the worst is over, but I'm saying you're really about to see how fucking wild this crash is going to get. And if you want to trade it and max it out, like I said, there were days when markets were bouncing. So as a trader, sometimes, I mean, you may not understand the severity of current market conditions, and you'll probably jump out of the trade just to later kick yourself in the ass, understanding, oh my God, if I just held that trade, I mean, I would have made millions, right? Well, most of you are going to jump out of an ideal setup. Most of you are going to panic on a bounce. And so if there's anything that you can take out on the day-to-day historic analog from 1929, don't just expect the market to be dropping every day. And use those pauses in the market like that of October 21st, 1929, as a day to build your position on a couple of days when the market closes in the green in October 1929. Those are the days to add to your short positions. In terms of put options, you should be maxing your trades the fuck out on any day right now that the market is pausing or slightly moving higher and attempting the rally on weak-ass volume. So the point is, most of the traders are too goddamn emotional. They're going to jump out at the worst possible time. So if you've done that in the past and you can relate to that, the best thing to avoid that is to trade with a 13 Market Moves coach, because I'm telling you, if you're trading with me, you're not fucking getting out of the trade on a goddamn bounce. That's a fact. So it's the easiest thing in trading is to open the trade. Now, the most difficult part of the trading is to actually stick to your trade through the bounces, okay, through the normal stuff that the market is going through. But, when you have a big position on, okay, most of the people can't handle it. They're going to break down. They're going to look at their fucking P&L. They're going to have a fucking heart attack before they achieve their victory. So if you're sick and tired of making the same fucking mistakes, okay, trade with a 13 Market Moves coach. Make those millions. Some of you are going to make 100 to 100 million in the next, 5 to 30 days. So if you want to finally make it big, guys, get in touch with the 13 Market Moves coach and finally fucking make it big.